People do business with people that they know and that they trust. That was one of the first lessons I learned in business. You can't just be transactional. You got to cultivate, develop, and build relationships that will last you over a sustained period to help you achieve your business goals. Welcome to our sponsor mini-series. This mini-series is designed to give you a deeper insight into 4 categories: workforce development, technology, risk management and insurance, and third-party administration. You're going to get an insight into the people and the products that's bringing the value to your business. Now, if you're like me, one thing I hate is to be sold something. It just doesn't feel right. Just give me the real answers. I'm going to ask the tough questions. Show me what you can do and what you can't do, and I'll make my own informed decision. And sometimes we'll find out if the solution doesn't work for you, but we're going to go deep. And if you find this interesting or you want to learn more, check out our sponsors in deeper detail. Go to their websites. But when you call them, make sure you use that L12 discount code because, they're giving you free money. You might as well use it. So sit back, relax, and enjoy the mini-series. I'm Jason Burns, your host on The Last of First, and I'm excited for you to learn, uncover, and discover what can work best on your Last of First journey. All right, welcome back to our second episode with CUI. We're talking about risk management, insurance, and how you can better protect yourself being a final mile, last mile business. So I mentioned earlier that one of the reasons that I joined CUI was because I didn't want to maintain status quo. And one of those things was captive insurance. Now, many of you probably don't know what captive insurance is. Don't feel bad. I had no idea. I heard the term maybe 3-4 years ago at a conference. I was like, what is that? What is a captive? What? So the first person really sat me down and explained captive insurance was Tanner. So Tanner, welcome back to episode 2.
Thanks for having me, Jason.
Absolutely. So maybe just start there. What is captive insurance? You got a lot of experience and you're one of the leading brokers of captives in the country. As I mentioned, I was so intrigued about this concept and wanting to introduce something new, something innovative that I had never heard of in the final mile space, although there are a few people that actually are part of these captives today. At a high level, what is a captive and kind of what they do, what do they cover, and maybe start the conversation from there. Like, how is it different than the standard market insurance that most people get today?
The captive space has definitely changed over the past decade, but most captives that we write are group captives, and so they are insuring 3 lines of coverage: workers' comp, general liability, and auto. From an outside perspective, as an owner, you wouldn't change much of what you do besides focus on more safety. I think the biggest thing, from traditional insurance to captive is, from an owner, people, I will say the intricacies of a captive, like, oh, what do I got to do? Now I got to defend my own claims. Do I have to have my own claims manager, loss control, all the above? No, from the outside perspective, you're still pay your premiums monthly. Mm-hmm. You got different options just like you would in traditional insurance, but you're betting on yourself versus the status quo of traditional insurance.
What does that mean specifically? What happens traditional versus captive?
Yeah, so traditional, right? Let's just say your premiums are $500,000. You pay that in a year and it's gone. You write a check out, you'll never pay more, or you'll never pay typically less, depending on obviously vehicle count, right. But you pay that for the year and it's gone. Where captive, you have a significant chance, let's just say roughly 50% of your premium can come back to you that year. So you have a real risk reward where, hey, based on my experience as an owner, I have had 5 years of continually good claim management and low claim frequencies. Yep. So I would look at this captive insurance and we would obviously analyze it and go into detail on it, but it's like, simply put, do you want to bet on yourself or the traditional insurance? And typically premiums versus traditional start out probably, I would say, up to par with traditional. Sometimes they can come in significantly less. Sometimes they can come in more. It all depends. It all depends on their claims. Okay. But what I love is the main points are you can earn back up to 50%, roughly. Some captives that we represent are a lot higher, but let's say roughly are 50%. You're able to earn investment income on your premiums, which is another positive. Mm-hmm. Until the actual check's written on a claim, you're earning investment income. So if there's a reserve for $200,000, that doesn't lock up your money. You're still making investment income until that check's written.
Okay.
I think the biggest thing that I love and that I've been doing captives for probably close to 10 years now. And I think the biggest thing is you're bet on yourself. So traditional, let's just take a carrier that people know in this space, Berkeley North Pacific. Well, they're going to take their worst clients and their best clients and say, okay, here's our rate this year. Because they have to be solvent to pay claims. They
cover everything.
They got to cover it.
Make money.
They got to be financially capable to pay them. So it's like, here's our rate for the year. You know, maybe we can deviate depending on the client 20%, but here's our rate for the year. Take it or leave it.
Yeah.
Where in captive space,
Like the sort of good kind of stuff for the bad in that model.
oh yeah, for sure.
Yeah.
The captive space, it's only based on their experience, literally. So I've seen clients take significant rate reductions year over year, where traditional insurance could never even come close to what captive insurance can pay versus traditional insurance.
And it's because you're solely looking at that particular company's loss ratio, their claims over the last 5 years or so.
Yep. And it's the same thing as traditional. They offer $1 million, and then depending on the captive, some of them will do 5, some will do 2. So it depends on the captive, and then you'll buy traditional excess on top of that, just like anywhere else. So if you had a $5 million claim and they had $1 million policy,
Yeah.
it's the same thing that would happen in traditional world. File a claim, the primary carrier, underlying carrier would pay the first $1 million, and then the excess would pay on top of that.
So it's for your general liability,
Yep.
workers' comp, autos. So
Autos.
you have owned or leased equipment in your fleet. So you're not 100% IC model. Yep. The way I can explain is like going from being the backup quarterback to the starter. So like you're no longer rated in the standard market. The ball's in your hands. You perform well, you play well, you can get money back. We'll get into more of those details in a second, but you're rated based off of how you play, essentially.
Yeah, and it's only based on your experience.
So you basically, the ball's now in your court. Like, why would everyone not want to be a part of a captive? Sounds too good to be true. Are there some criteria, like qualifications you got to have to even be considered to be in a captive?
Yeah, for sure. I think the first and foremost, most of them require 5 years of business.
Okay.
There are some final mile captives that are doing 1 year plus in business. It depends on how those are obviously written. We represent a couple now. It's more, I would say, the DSP space.
Okay.
But most of them are typically 5 years of business, and they need to be at least premiums of $200,000 for not all lines. Again, just workers' comp plus GL plus auto.
Okay.
So auto liability, auto physical damage, workers' comp, GL. Those have to total 200 to start the talk.
A certain loss ratio they're looking for there?
Yeah, I mean, the loss ratio, going back to...
Explain it, just so we haven't, I don't think, defined it yet. For a person that's just watching for the first time, like,
Yep.
What is the loss ratio? Simple example.
Yeah, so your loss ratio would be, let's just simply put, you're paying $100,000 flat for your commercial auto.
Okay.
Okay. And you had $40,000 in claims that year. Your loss ratio is roughly 40%.
Okay.
Holistically, for a captive candidate, which would include workers' comp, loss runs, GL, which, not going with it, most times they won't have GL claims, and auto claims, you want to be in the threshold of 40% or less.
Okay.
You could probably go a little higher, it depends, but a lot of times the numbers don't, they probably won't make sense. And so those are the main categories are years in business, threshold on premiums, loss ratio, how have you mitigated your safety, your claims.
Okay. So if I kind of meet that criteria, is there, well, we know there's a collateral requirement. So part of the skin in the game, when you apply for a captive submission, they're going to do all that kind of background check that you mentioned. And if you qualify for it, then there's a collateral requirement for you to put skin in the game. And that's where I think most people start to maybe get a little hesitant with a captive. But explain that from your experience, like what that collateral typically, what's it doing? What's it there for? And then roughly some sense of maybe how that is priced as a percentage of the premium or something like that.
Every captive is done differently, but most of the captives that we represent, and I will say we don't just represent one captive manager because we try to sell what's best for the client at the end of the day. And not one captive is necessarily perfect. why captives have collateral is because your premiums are there to pay essentially to an extent, right? There's thresholds on different claims on how it's paid, frequency, severity, A and B fund, which you guys don't need to necessarily know right now, but there's thresholds on that. And so your premiums are there to help pay for portions of your claims. And collateral component is just there to protect the other members and yourself.
Yeah.
So in the event of a new member comes in and you've been in the program for 3 years and they sign the deal and 45 days in, they have some significant claim activity and then they decide to file Chapter 11 bankruptcy.
Yep.
Well, all the other members in that group will then have to subsidize and pay for those claims. And so it's just there to protect the other members, or in the event someone were to leave or do something illegal or something, it's just there to protect the other members. So it's just there as a security that everybody has to do the same amount. So it's percentage of their premiums.
Okay.
And they all have to do that typically for about 3 years.
Okay. It's kind of like a security deposit that you get back over. You're eligible to get back over time as you perform better. So there's a group component to it where you can maybe have an assessment. I think we call it an assessment, where you can have to put things in the pot. But by and large, if everyone's operating well, because a captive is, they want the cream of the crop, right? They want the best of the best. They're not letting everybody into the captive. It's like the VIP of insurance. So in theory, you have the better insurers in the captive. Everyone's put their fair share of skin in the game, and they're operating at a clean loss ratio rate. Things do happen, and from time to time, you may have to put additional money into the pot. But like you mentioned earlier, when you perform well, that savings that you're essentially saving the insurance company by not causing claims, you're now able to recoup some of that money back as either reduction in premium or dividend. So with the collateral, is it always cash? You have to put up just more money, and so you're by effect just you have to be very liquid to put more cash up, or is there any alternate way of posting that collateral?
That's a great question. Typically, there's 3 ways of doing it. Post cash, we can finance the cash over a 12-month period.
Okay.
So they pay monthly.
Okay.
LC, letter of credit from the bank. And it just depends on the year. So before our interest rate spike, we were financing premiums at like 2. And so most of our captive managers, they're making around 5-ish% investment income every year. So finance 2%, paid over a 12-month period, you're still making 3% that year. But then, so it just depends on how the interest rates are. And then you can also do a letter of credit from the bank, which is pretty simple.
Okay. So there's other options. So you don't necessarily have to have all this extra cash laying around to get in the captive. So,
yep.
Okay.
And I think, another idea is people are like, oh, I have to have all this done at this very moment. Most captives give you a leeway of like 60-day grace period to get everything set up.
Okay. So there's some runway to kind of get yourself into the captive and get fully compliant.
Yeah.
I want to go back to one of the things you said a second ago. You mentioned the severity versus frequency funds, or A fund, B fund. Maybe explain that in terms of a captive and why that's advantageous for an insured to be in it, because I know at some point, the higher the claim, those severity claims, they're a little more forgiving on those versus if you're in the standard market. What's the frequency fund versus severity fund? What do captives hate about that? And then what's the upside if you're in a captive, if you have these severity claims?
Yeah, A and B fund, severity, frequency fund. The A fund or frequency fund, that's a great way of putting it, as a frequency fund, is really claims depending on the captive are $1 paid out in claim to $150,000 paid out in claim.
Okay.
And then let's say you had a $200,000 claim, that would then go into the severity or the B fund. So that layer is the first layer. And really how a captive or an actuary looks at a captive in numbers is it's all based on that A fund or that frequency fund. And the severity or B fund is kind of a component of the A fund. It's a percentage. And I think one of the best things to look at is in a captive, if you're looking at doing one, is, they reward for severity and they penalize you for frequency. Why? If most traditional insurance or actuaries are the same if you're in traditional versus captive. There's no difference. An actuary looks at numbers, and here are the numbers. Any carrier, they don't like frequency because frequency breeds to severity. And eventually, if you had a customer that had 10 claims at $30,000 a pop and one customer that had one claim at $300,000, well, or let's just say at $500,000, they'd rather take that one customer with the one claim versus the one that has 10 in 1 year.
Why is that?
Because unfortunately, those 10 claims, one of them in time, theoretically, is going to be a large claim. And the more smaller claims that you have, they look at that as either mismanagement or driver safety, and there's going to be eventually way more severity of claims.
Running a delivery business comes with risks, but being unprotected shouldn't be one of them. That's why many successful business owners trust CUI Agency for their insurance and risk management needs. For over 50 years, CUI has helped transportation companies understand their unique risk, learn how to reduce their costs, and protect what matters most: their business, their people, their assets. Specializing in commercial auto, hire and own, cargo, warehousing, and other liability policies, the CUI team tailors each solution to fit your needs, coverages, and risk. So no more last-minute quotes, and definitely don't leave your future to chance. Visit CUIagency.com, speak to one of our experienced producers, and take back control of your destiny. Now back to last to first. Yeah. So they'd much rather you have these anomalies, these kind of one-time events that maybe you can control as much versus these smaller claims, 10, 20, 30K, which is showing that, hey, something is not right here, and we need to fix that so we don't have numerous large severity claims.
Yeah. I think going back on the claim standpoint, though, a thing I love about the captive is I personally have never seen someone kicked out. That can happen, but I haven't seen it with any of my clients or anybody. But let's go down the scenario of a rough year. If you're in traditional, a rough year, probably getting non-renewed or taking a double or triple rate increase, probably.
Yeah, rough year meaning you above that 40% loss ratio. Yeah.
No, I'm saying a rough year, like 100% plus loss ratio.
Got it.
Like a real rough year, 40%,
no, but
60%. I mean, unfortunately, in the auto market, you're gonna
off for the course.
Yeah, that's why I love the captive. They look at 5 years. You should have 3 average for what you've save that one really good at maybe 5-10%, and then a bad year at 100%. That all equals itself out to get their rates.
Got it.
In traditional, they're going to look at that year, and you're either going to get non-renewed, they're going to cut and run, or you're going to see some significant rate. I think as an owner, you're always worrying about like, okay, what's the worst? The worst could happen. It's like, okay, I get non-renewed. Well, I need insurance. If you can fit and get approved to be in a captive, which is what takes typically Class A accounts to be in the captive space, and you need to be approved by the board. But I've never seen someone non-renewed. So you got that first thing going for you. But then let's go to the next step. You have that bad claim year like we talked about, or you have consecutive bad claim years. I've seen customers in the captive space. They were the golden child the first 3 years, and then they joined the captive, and then it's like all hell broke loose.
Yeah.
If they were in traditional insurance, their rates, they wouldn't have been insurable in 3 years. Where the captive, did they take an increase? Yes, but it was still manageable to manage their business.
So I know we have a number of clients, both in final mile, outside of final mile, in captives. Maybe share some examples of success where clients have come in to captive and have seen some of these benefits of premium reduction, the dividends back, and are there any other benefits of being a part of that group? Do they get any other resources or things that can help them mitigate risk?
Yeah, I think they're one huge benefit. All captives, a percentage of their premium goes towards loss control and safety. And typically their loss control people are third-party individuals that are specialized in that space. So if it's final mile space, trucking, transportation, they've been doing that for years and years.
Got it.
If it's construction, manufacturing, vice versa, they have personnel that is particular to your space, and they know it very well.
Yeah.
So they can come in, do loss control meetings, safety meetings with your employees. They can talk to leadership to say, hey, here's what, when you join the captive, you go do like a safety analysis, and it really shows. They go through everything, all the nooks and cracks of everything. It's like, it's not there to penalize you. It's there to say, hey, how can we get better?
Yeah.
So that's a huge positive. Another one is claims. They know that your premium dollars are being essentially there to pay claims.
Mm-hmm.
So they're a little more lenient. Like, instead of just paying a claim, we can actually deny a claim, go get surveillance on that claim, and defend ourselves if we had to. Because a lot of times, if you're going to deny a claim, that employee might come back and litigate the claim.
Yeah.
But if we can have the evidence to prove that, it's way better than just paying $10,000. I'm all for defending it, like what's right versus what's wrong.
Yeah. Yeah.
So claims, loss control, captives really reward for growth versus traditional insurance. So a success story is, I've had a customer in the most litigated state, or one of the top litigated states. They've gone from, when they first joined the captive, they were paying about a $6,000 per unit annually for premiums.
Okay. The auto side.
On the auto side.
Okay.
They've been in the program now almost a decade, and they are paying roughly $1,000 per unit annually.
Wait. It went down from $6K per unit down to 1,000?
Down to 1,000 per unit.
How does that happen?
That's why I love the captive, because it's only based on their experience. They're not going off the status quo of traditional insurance where that carrier has to pay claims and they got to have a rate for that claim. Captive is only based on their experience. It's true in captive as well. Like, let's be serious. They're not all success. Sometimes you're going to see a rate increase. But what I love about the captive, it's your fault, unfortunately.
Yeah.
Like, you had a bad year or consecutively bad years. You're seeing rate increase. Well, the captive doesn't have a component on how the whole market's doing. It's based on you individually.
So you don't get these answers. Like, I would always get, my last year in business, our insurance went up like 33%, and we had a clean year. And I was like, well, why did it go up? It doesn't happen. Like, well, it was the market. We had a rough year, rough environment. So you won't get that answer in the captive. You're saying you will get Tanner. I mean, look.
Yeah, it's like,
look, as my football coach would tell me, the film don't lie, right?
You can pat yourself on the back or you can shoot yourself in the foot.
Yeah.
I mean, unfortunately, that's why I love it, though. It's, as an owner, and especially if you've had a good history, right? That's why we look at the 5-year history, or you can look at a 10-year history. It's like, do you want to bet on yourself?
Yeah.
Or do you want to just go the game of the traditional? But I do believe if you can fit into a captive model, it's not for everybody, 100%. It's really not. Mm-hmm. But if you can fit into it makes a lot of sense.
But even in that, just to cut you off for a second, even in that scenario in which the premium is going up, it's still probably more forgiving than if you're in standard market, because the captive will work with you. They got all these programs and risk mitigation, and the percentage of premiums already allocated to help with the safety, versus standard market. You come up for renewal with a terrible year, it's like non-renewed.
Yeah. 100% agreed. I think, your increase will be significantly less than traditional insurance.
Got it.
I mean, let's go through that though. So, people that don't understand captives will always say, "Oh, there's these negatives about them," and obviously we're talking positives. Same as workers' comp. I've had customers, we'll do another couple success stories. In 1 year, they took a 32% rate reduction in 1 year on their workers' comp rate. That's significant. And anybody that's in the final mile space, like, it's low margin space. Mm-hmm. And I mean, to this day, like, they need to pay shippers more to get things delivered. So final mile companies can make more money. Yeah. I do believe that. That's another whole conversation.
Yeah, it's another episode.
But it's fun to see success stories, and that's why
You're going down the path of workers' comp, though, because there's some unique things.
Yeah, that's what I'm saying. So that's why I love success stories on the workers' comp. In 1 year, they could take that good of a rate reduction. It's fun to see. You're in the space now too, doing insurance, and it's a lot harder conversation when it's an increase versus a decrease. Like, oh, hey, yeah, here's a nice 32% rate decrease, and it's like, but what I love is, it's not about myself. It's like, hey, you guys have performed extremely well over the past few years, and now you're seeing the repercussions of it. Yeah. You're seeing the success, but on top of that, you're also going to get dividends back. So that's another fun play, is the dividend component of premium. So again, if you're paying 500,000, roughly most captives are going to be 50-ish%. We have some that can go all the way up to 78% on a return on a dollar. So every dollar you're spending, you get a chance to earn back 78% plus investment income.
Because you're essentially an owner of the captive.
Yeah, you're an owner of the captive with all the other collective members of the group.
You're the shareholder of it.
Yes.
Okay.
There are single parent captives where you can do your own captive, and that's only you and yourself.
Yeah.
And those will roughly start about $2.5 million of premium plus.
Go back to the workers' comp side, because I thought you started going down the path of in the final mile is different, like every company, different work categories, class codes. So typically final mile, you have customer service, dispatch, some management there. And then you get to the warehouse side, you're going to have warehouse laborers, people driving forklifts, riskier category. Obviously, you have W-2s, drivers. But in a captive, all that's kind of average and blends together.
Yeah, you're exactly right. It's called a composite rate.
Yeah.
And people that are selling traditional versus the captive will say, well, yeah, look, your clerical just went from a 12-cent rate to a $3 rate.
Mm-hmm.
Realistically, like, just look at your premium as a whole. Like, if in traditional you were paying 500, but now in a captive you're paying 400, well, your net, you're saving 100,000 plus earning, dividends down the road eventually.
Yeah.
But yeah, I love it because for your controller, your CFO, whoever's doing the books, it's one rate. So you know what your audit's going to be at the end of the year, and either it's going to be, I guess, take a step back. People think, oh, what's the audit process? It's all the same as traditional. There's no difference there. They're still going to look at everything the exact same. But what I do love about the captive space is if you have you grew that year a lot, and you had a large workers' comp audit, same as you're going to have a vehicle audit. It's all composite rated, which you'll know what your premium is. So let's just say you paid $200,000 for workers' comp, and you knew you were going to get a bill of $100,000. You had a good growth year. Well, if your claims were good, which at CUI, we give them a monthly analysis on how they're doing, which is, I think another strong suit of CUI. We're not just here to sell you a policy. We're here as a partnership, a long-term to make you safer and hopefully better.
Yeah.
But on that $100,000 workers' comp policy, well, if you had a great year on claims, in traditional, you're just writing a check out for $100,000, it's gone.
Yeah.
In the captive, you're going to get 50 to 70% of that back in 3 to 5 years.
So it brings to maybe one of my last questions on this part of the captive. When you get those dividends back, do you have to use that to pay for next year's premium, or is there flexibility as an owner? Can I do what I want to do with that money? Can I put it anywhere I want, or do I have to allocate it back to the next year's premium?
No, you get to do whatever you'd like to do with that money. So it goes, you create an LLC or can go back into the operating entity of the company. Okay. But no, that's yours to spend how you like.
Okay, so I can take the office on a trip to Cozumel.
Yeah, I think what I love is they can see based on their premiums, like, well, I got this much to like risk. And it's like, why not spend maybe a little more on safety and promoting safety versus kind of neglecting it, maybe, because you got that much more to gain back.
Yeah, and I bet you probably see a lot of the owners who are in a captive. They're probably much more in tune to what's happening from a risk management standpoint, because now it's like anything else. Right now, I know it's a potential ROI coming back. It's not just money going out the window. So I'm paying attention to it more. I'm on top of my safety director more. I'm pushing training because I know there's a big potential ROI benefit there that helps the whole organization, versus in the standard market, I'm probably just sitting there thinking, like, how can I save money? How can I save money versus how can I actually mitigate this risk that benefits everyone and keeps all my team and employees safe?
100%. Yep.
So we're hearing about a lot of the benefits of a captive and the criteria, but inevitably this, it's not all positive, right? Are there any risk or downsides of a captive that you've experienced or your clients have experienced?
Yeah, most captives that we represent, they're going to have what's called an assessment feature. And it's not big severity of claims, it's small frequency claims that the captives do not like. We talked about that frequency A fund,
Right.
and the threshold of like $1 paid to $150,000 or $125,000. That threshold, there's a component of that, and typically the assessment is a component of that frequency A fund. It's not as big of an assessment as you would think. If you're roughly paying $500,000 of premium, your skin in the game, that assessment feature could be $150,000.
Okay.
So in a given year, and the assessment feature, they're not going to come and say, pay that right now. They let you pay that over a 3-year period.
Got it. So are you only charging assessment if you have a bad year, or is it built into the, like you can assume you're going to pay some percentage of the premium as an assessment?
Nope, it's an additional cost to the premium. So if you paid $500, like we referenced, that $150 would be paid over a 3-year period.
Okay.
On top of your premiums for the next 3 years. So your first 3 years, you're gonna roughly spend a little bit more money on traditional versus captive, because you got collateral, and then I guess if you did have an assessment, you'd have to pay that assessment over the next 3 years. It's a long-term game. So captive isn't for a 1, 2, 3 year mark.
Good point. Yeah.
It's a long-term commitment, but you're betting on yourself, and the extent is you're not. What I love is traditional. It's gone up 9 years in a row.
Yeah.
Captives, I've seen customers, like we talked, take significant rate decreases. So you're betting on yourself. And yeah, there is an assessment feature, but there's also a dividend feature. And then the collateral. And I think the last thing, I guess the two skin in the games, people are like, oh, well, if I join a captive, I never get to leave. Back to it is a long-term commitment. It should be.
Yeah.
But the reality is, like, let's just say you join, you could leave tomorrow. It's easy to leave. The only hiccup is your collateral will be stuck there for 5 years. So you'll get your collateral component plus your dividends if you've earned any since you've been in the captive, and your investment income. That'll come back roughly 5-6 years later.
And that's because that money's still there for any claims that could be lingering on.
Yeah, and to the point, right? Like the assessment feature, if that client leaves that year and the year before they still had a bunch of open-ended claims that weren't paid, well, that created an assessment. And if that member is like, well, screw you guys, I'm not going to pay them, they could tap into that collateral to protect the members.
Got it.
The collateral component's it should never be touched ultimately. It's just there to protect members and yourself.
Yeah. No, I love it. And this is again, opened up talking about, I think the one thing I hope this episode does, or this whole miniseries does, is open up the eyes of owners to understand there's different options for you to play with. Not just options from the broker you work with and who's going to service you and be that partner, but different types of coverages, and certainly standard market versus captive insurance. And even within a captive, there's the single parent captive, there's a group captive, and which we talked about a lot today, where we've seen a lot of our clients have success. It really goes back to, hey, if I'm in this space and I'm seeing the reality is rates are continuing to do nothing but go up, and I feel like I want to do something about it, I'm frustrated with it, and I'm running a good business and I've got good safety in place, or maybe it's something I can do a little bit better, but I'm willing to make that investment and I want to control my future, a captive is a great solution for you, but understand it's not for everyone. They want the best of the best in it. But like everything else in business, you should want to be in that group, right? So
I mean, that's how it started. It was a masonry contractor, and he's like, "Why does my GL and workers' comp rates keep going up? I have no claims. I control my costs. I do this and that to reduce my claims, and yet my premiums keep going up." And that's how it was started. Was by a masonry contractor.
How about that?
Yeah.
Well, thanks for joining us on episode 2 of our mini-series with CUI, talking about risk management, risk mitigation, and captives, right? So if you have any questions about this episode, reach out to us. You can find me anywhere you want to find me at. I'm on LinkedIn, Instagram, social media's there. But go to our website, cuiagency.com, and learn more about our captive solutions. And if you have any questions, reach out to us. We'd be happy to help. Thank you.